Hello, welcome European listeners and market participants, and welcome to KBRA's latest European Credit Podcast. I am Gordon Kerr, Head of European Research at KBRA, and today I'm joined by my colleague, Asia Drobnik, from our Financial Institutions Ratings team, and Kali Sirugudi from our RMBS Ratings team. Today we will be discussing the UK building societies and the risks that they face from the UK housing market, covering the content of the recently published report, UK Building Societies Prepared for Challenges Ahead. And of course, we will cover more content beyond the report as well. The report and related information can be found on kbra.com. So starting off with the housing market in the UK, what can we really expect for the UK mortgage market going forward?
Thank you, Gordon. At KBRA, we are expecting, number one, the volume of property purchase transactions to fall relative to the numbers seen in the last year. The fall in demand will be driven by the weakened mortgage affordability. You see, mortgage affordability is expected to be affected adversely by the rise in cost of living and the energy cost, and hence disposable income to service debt will be lower. And that's on one hand. Now, on the other hand, we see rising interest rates, which will mean a smaller loan eligibility for borrowers, which when combined with the borrower deposit, will fall short of the property price. Second, as a consequence, the expectation on gross lending will be a fall in that lending numbers as compared to last year again. And as you know, Gordon, the gross mortgage lending increased about 27% year on year to £316 billion in 2021, the highest volume since 2007. And thirdly, KBRA expects, and driven by the weakened affordability for borrowers who expect house purchase, that the house price growth will cool off the boil in the context of a 17% increase in house prices observed over the pandemic period to December 2021. And the only factor supporting house prices there will be the perennial low supply of new housing units. I hope that answers the question, Gordon.
Now, you highlighted the fact that we are going to face some challenges, where borrowers will face challenges as we move through the coming year with inflation rising and energy cost impacting individuals and borrowers. So how do we see that starting to flow through and impact mortgage performance going forward, given these costs of living increases combined with the increase in interest rates?
That's a good question, Gordon. It's not the easiest to predict, but we can certainly look back on some of these stressed periods in the UK where delinquencies have risen. And in general, KBRA expects mortgage delinquencies to rise. And you've seen that the delinquencies had increased over the pandemic period and have now settled at a lower level. And this has been the case for mortgage performance for quite a number of years now. So that small rise in delinquencies expected will be affected more by the higher energy costs and cost of living in general, and to a lesser degree by the rise in interest rates. And that's because a meaningful proportion of your outstanding mortgage debt in UK is on fixed rate of interest, and with a higher proportion in recent years in the 5-year fixed rate product. And so that's the reason why even if you have further increases in the interest rate, it will not straight away affect the majority of these borrowers who are paying only a fixed rate of interest. Building societies and servicers have the experience of dealing with delinquencies over the pandemic period, and KBRA expects brief payment holidays and or arrangements to pay, possibly to be used to deal with the rise in delinquencies expected. And I think lastly, that the severity of the rise in delinquencies will depend upon how persistent inflation would be at high levels. So it's certainly something which KBRA will be monitoring closely.
Thank you very much, Kali. So, Asha, with that backdrop, the picture doesn't necessarily look too pretty, but not too severe either. With that backdrop, what is our credit view on the UK building society sector?
Thank you, Gordon. Yeah, in our view, the sector, especially the larger and the better performing smaller institutions, have sound credit profiles. We believe that the sector can absorb the continuing macro pressures. But saying that, the societies, given that they have undiversified business models, they are inherently vulnerable to a downturn in the housing market, rising unemployment, and increasing cost of living. So over the coming quarters, we would expect the sector's profitability to be pressured and the asset quality to deteriorate. But those forthcoming credit challenges are mitigated by society's generally sound capitalization, strong liquidity, and stable funding.
Great. So you mentioned there that profitability is expected to be pressured in coming quarters. Can you please extend on this? I mean, what's going to impact on that profitability number?
Yeah, sure. Let me first speak about the last year's performance of the sector, just to set the scene, because we saw a significantly higher profitability compared to 2020. And this was due to strong mortgage lending volumes, which Kali mentioned, improved net interest margins, and reversal of loan impairment charges. So let's focus on the margins for the moment, which show strong improvement in the first half of last year as the competition in the savings market remained low and demand for mortgages increased. And let's not forget that they still benefited from cheap wholesale funding from government funding schemes. Now, the second half of the year, on the other hand, saw increased competition in the mortgage market and to a smaller extent in the savings space, leading to lower margins. And we expect these trends to continue putting pressures on margins despite the rate hikes. As I mentioned, the sector experienced strong new business volumes last year, especially in the first half. But in our view, the continuation of this recovery in the medium term is unlikely, given the inflationary pressures and the uncertainty around the war in Ukraine. And that's the issue here, as given the lack of revenue diversification for majority of the societies, their profitability heavily depends on their ability to grow the loan books. And then lastly, the overwhelming majority of the societies released the loan impairment charges last year, reflecting strong house growth and better than expected performance of the mortgage customers who took payment holidays at the start of the pandemic. However, given the more negative economic outlook, we expect the societies to report higher loan impairment charges this year, although at levels lower than seen in 2020, as the majority of them still carry provisions they book in relation to the pandemic and which have not been released yet. So to sum it up, we expect the sector's profitability to be pressured by still relatively low net interest margins, increased loan impairment charges, and the likely slowdown in mortgage lending.
So thank you very much. Another credit risk that you highlighted, and Kali also pointed out at the top, is the expectation of a weakening of asset quality. Can you maybe add a little bit more color around how that will happen with regards to the building societies themselves?
Yeah, no, absolutely. So in line with their peers and the UK and European peers, the society's asset quality remains strong throughout the pandemic, stronger than expected, actually, thanks to the wide-ranging government support for the borrowers. Yeah, but we do expect the sector asset quality to deteriorate over the coming quarters as the implications of higher interest rates, to a certain extent, inflationary pressures, and the full withdrawal of the fiscal support measures feed through to the economy and customers' affordability. But saying this, the society's generally conservative LTVs and supportive credit profiles should help to mitigate any potential loan losses.
Thank you very much. That was a very good summary of the state of the UK building society sector and expectations going forward. I have one more question, and that's really, it's been a hot topic, not just in the UK, but globally, and that is the question about ESG. Can you maybe take us through a little bit on how ESG is reflected in the UK building society sector?
Sure. So since the beginning of our coverage of the sector, we have highlighted the society's inherent social focus. Like building societies are mutual institutions owned by and working on behalf of their customers, and they typically focus on longer term sustainability. The societies have a long and important history of providing savings and mortgages across the UK and are inherently focused on helping their members to save for and buy a home. So this underlying social agenda means that they tend to offer services that include lending to market segments that are poorly served by mainstream lenders. And this would include first-time buyers, self-employed, and lending into retirement. More recently though, to support an increasing number of customers who incorporate environmental needs into their decisions, we can see more and more building societies are offering or planning to launch green mortgages. Most of their current products are in the form of discounted rates for home improvements that will increase the energy efficiency of a home. But we believe that their green proposition will continue to develop.
Great. Thank you very much for that. Asia and Kali. So, in summary, we here at KBRA expect to see challenges developing in the UK housing market as borrowers face the current rising rate environment, inflation, and the cost of living due to increased power prices, and the overall impact of various macro elements on the economy. However, the UK building societies, while exposed to the challenges of borrowers across the UK housing market, are well capitalized and well prepared for any potential increase in delinquencies and defaults. Thank you very much for listening. We look forward to bringing you more conversations in European credit. Don't forget to check kbra.com for our latest ratings and research. Stay safe, and we will speak to you again soon.